Hello, today is Wednesday, June 16th, and thank you for joining us for another edition of the Market Commentators podcast. In a change of pace, my name is Jake Willems, quantitative analyst at the Milwaukee Company, starting us off here today. And joining me as usual is my father, Andy Willems, the president and CEO of the Milwaukee Company. Today we have a special guest with us, attorney Maureen O'Leary, the president of O'Leary Guth Law Firm. And today we're going to be talking about wealthy Americans and taxes and whether or not they're paying too little or too much. Before we get started, please keep in mind that this podcast is for informational purposes only and that the views expressed in today's podcast are not necessarily those of the Milwaukee Company and nor that of O'Leary Guth Law Firm. Good morning and thank you for joining me, guys.
Good morning, Jake.
Hi, Jake.
So let's get started here. I figure the best place to start would be to talk about the discussion and what's on the table in terms of new taxes. Andy, could you summarize for us?
Sure. There are 4 tax hikes that are making their ways around the Hall of Congress. First is the raising of the top tax rate on Americans making over $400,000 a year. The second is approximately doubling the amount of capital gain taxes paid by investors who earn more than $1 million annually. The third is repealing the basis step up on capital gain taxes at death. Jake, you might remember we've talked about that one in the past on prior podcasts.
That's true.
And lastly, there's an idea that seems to be gaining momentum is imposing a wealth tax on the ultra wealthy.
I understand that there's also been some talk about a corporate tax rate increase, Maureen. Is that correct?
That's correct, Jake. President Biden's original infrastructure plan proposed raising the corporate tax rate from 21% to 28%, which would unwind the tax cuts in that area by President Trump in 2017. But the Republicans have described this change as a political non-starter. Republicans are opposed to raising taxes. And news reports have suggested more recently that President Biden is willing to forego the rate hike to 28%, but in exchange, he's looking for a new minimum corporate tax of 15% across the board. This has been labeled the so-called Amazon tax because it's aimed at profitable companies that pay low corporate tax or are able to move their profits to different countries to try to enjoy lower tax rates. That's why the White House is also proposing an overhaul of taxing multinational corporations that raise more than $1 trillion in revenue.
Let's dive a little more into that rather sudden focus on raising taxes on the wealthy. And Andy, I'd like to start with you. What has led the efforts here?
Well, the idea is to try and close the income gap and to fund social programs and entitlements. And this has long been a plank in the Democrats' political platform. And now that the Democrats control both houses of Congress and they also control the White House, they're in a much better position to try and see their policies implemented. But there's another sort of stealthy reason for trying to raise the tax on wealthy, and that is because there are a lot of coastal Democrats, Democrats on the East Coast and the West Coast, want to repeal the limits that are on how much state and local taxes can be deducted. I think the limit's now, is it $10,000, Maureen?
Correct. Mm-hmm.
Okay. And so a lot of these, coastal states that are strongholds of the Democrats, they collect much larger state income tax and property taxes. So that limitation, that so-called SALT limitation, has been a big bone of contention with them. So if you're going to repeal that, you got to come up with another way to raise the revenue that you're losing by that repeal. And the Democrats are pushing to offset that deduction is to tax the wealthy more heavily. The ironic part about it is that the top 1% of all earners would get 57% of the benefits from the repeal of the so-called SALT limits, according to the Tax Policy Center. And in terms of this whole idea of a wealth tax, there were recently, probably everybody's aware of this, recently leaked secret IRS files that showed that billionaires such as Jeff Bezos and Michael Bloomberg and George Soros frequently pay little or no income taxes, So the idea is, well, let's make them pay a wealth tax instead.
But Andy, we got to keep in mind that data from the Internal Revenue from the Internal Revenue Service indicates that while the 2017 Tax Cuts and Jobs Act reduced top marginal tax rates, the top income earners still shoulder a larger share of the income tax burden. Specifically, based on 2018 data, while the top 1% of income earners collected about 21% of income, they paid over 40% of all federal income taxes. Similarly, the top 10% of earners paid over 71% of all income taxes, and the top 25% of income earners paid 87% of all income taxes. And all of these are higher percentages than prior to the passing of the Tax Cuts and Jobs Act.
That's very true. And the reason that's true is not that the wealthy are paying more in taxes than they were, but that the less wealthy, the average American, is paying far less because of the generous tax breaks that were put into the TCJA for moderate and low income Americans. So that's why those percentages shifted like that.
Why don't we focus a little bit more closely on capital gains? It hits close to home for us at the Milwaukee Company, especially. Maureen, what specifically is being proposed in that regard?
Like Andy mentioned at the beginning, President Biden has proposed approximately doubling the capital gain tax rate for investors who earn more than $1 million annually. So that would bring the rate to approximately 44%.
The benefits from a governmental standpoint seem pretty obvious. If we're doubling capital gains, 44% should be a lot more revenue going in. But why may this not be such a good idea?
Well, first of all, it might not work because according to a lot of estimates, at some point, the tax increase on capital gains could actually result in a decrease in government revenue because investors would simply avoid selling their assets if they feel the rates are just too high. And I'm seeing that right now with a lot of my clients. They're wondering if they're going to sell assets this year while rates are at a known rate, or if they're not comfortable paying those higher rates down the road, are they in a position to hold on to those assets for a long time until the rates come back down again, or if they come back down again, or if there's a basis step up upon their death, if they're in a position to hold the assets until they die. Because right now, the tax basis of inherited assets are adjusted to their fair market value when the owner dies. So that means right now a wealthy taxpayer can avoid capital gains taxes if they hold the asset until they die, and then the next generation can inherit that asset with what they call a step up in basis, so that the basis of the asset becomes its fair market value when it moves to the next generation. But to address this issue, President Biden has proposed repealing these so-called step-up in basis rules and replacing them with a tax on built-in gains at death. And making death a taxable event might sound like something politicians would like, since the dead aren't supposed to vote, but in reality, it's a hard sell.
Yeah, we've talked about basis before, Andy, especially with some of our previous podcasts, and I know you've mentioned why that could be a challenge to repeal that. So would you be so kind to elaborate on that again?
Sure. They tried repealing the step up in basis at death before, and it failed. When I first started practicing law many moons ago, they had tried repealing the step up in basis, but the situation was so complex to administer because you need to know what the person who died paid for an asset. The IRS said it's just too hard. We can't audit this. So they'd actually got to the point where they were sending returns back. And if you submitted a check, they returned the check too, because they said, we don't know how to deal with this. And there's a group of Democrats now from about a half a dozen other farm states and whatnot that also are imposing it. So it could be hard to get through for that reason. And the reason that those Democrats are going against Biden on this is that they're worried about their farmers and small business owners and whatnot having to pay a tax on gain when nothing's been sold, so they have no money with which to pay the tax. And another thing I think it makes this kind of a hard sell, is you put it, is that rich folks like Bezos and Musk and Bloomberg, they don't really pay much in the way of capital gain taxes. And so raising the rates is going to make a big difference to them, because rather than sell the stock they own in the companies that they founded, they simply just borrow against it. So they keep the stock, there's no sale, no gain, and they just get cash through borrowing against the value of their stock. And by the way, they can also deduct the interest they pay on the loans that they take on against their stock. So it's tough.
So then I guess I take it this is where that wealth tax idea comes in, because all the other ones we've talked about have problems. So, Maureen, what is this one about?
A wealth tax would be an annual tax on the net wealth a person holds. So the value of their assets minus their debts. It would be calculated on that asset value, not on the income that they bring in each year. So it'd be similar to a property tax, where people pay tax based on the value of their home, but it would be applied to all of their wealth above a certain level. The tax would be levied against the very rich, but the threshold depends on whose proposal you look at.
So is this a part of Biden's tax proposals, or is this just an alternative that people have been discussing alongside those?
Biden has not included this in his proposal. Some of his opponents in the presidential election, when he was getting the Democratic nomination, like Bernie Sanders, Elizabeth Warren, are strong proponents of it, but Biden hasn't, and I think it's for good reason. The proponents of the wealth tax say it's harder to plan around and it would help reduce wealth disparity. And there's some truth to that perhaps, but there's some very significant cons that, in my view, offset those pros. The first is that it could result in double or even triple taxation, because the federal government already collects corporate income taxes, individual income taxes, and estate taxes. But more importantly, to me at least, there's a real risk that wealthy individuals are just going to say, well, the hell with this, I'm getting out of here, and move to a country that doesn't have a wealth tax. And there's precedent for this. France adopted a wealth tax, and as a result, 42,000 millionaires left the country before they turned around and repealed it in 2018. So I think we would run the risk of seeing the same sort of thing happening here. And from an administrative point, it's very difficult to administer, because many forms of wealth are hard to value. Things like personal and household effects, artwork, privately held companies, real estate, and even some other investments. They all require an appraisal to know what they are worth, which means you'd be having annual appraisals, and be great for the appraisers, but very, very hard for the tax lawyers like Maureen, because trying to get these appraisals done every year would be, I would assume, Maureen, would just about be impossible.
Yeah, if anyone wants to get in the appraisal business, now is the time to think about it.
Yeah,
exactly.
I think that's a really good point. One thing I'll joke in there is that when you talked about personal effects and wealth valuation, there's an interesting thing going on. If you remember, Dad, when I was a kid, we collect little trading cards.
Yep.
Specifically in Pokemon, have skyrocketed in valuation. The collectors have been, it's unbelievable.
Did you save them?
No, I didn't, but I mean, it's actually, we're talking hundreds of thousands of dollars for these cards.
Wow.
And I just wonder if things like this wouldn't happen by accident if we had changes like this to the tax code, where the wealthy would find alternative means of storing their wealth to avoid double or triple taxation, as you mentioned. And it'd be hard to administer for sure. I can totally agree.
Yeah, some of this, could be resolved through exemptions, but then, you start getting into convoluted tax code like we have now. And Jake, how would you value Bitcoin? One day, these things that go up and down 80% in the course of a few months. So I think it'd be very difficult to efficiently and fairly administer wealth tax. But I think a flat tax would be a much better way to make sure the wealthy pay their fair share, and would be much easier to administer. much easier to for the IRS to make sure everybody's paying what they should pay. I guess the only people who would be out of luck would be the tax lawyers like Maureen. It'd be so simple you wouldn't probably need to hire tax lawyers, but that's my take. But we can talk about that next time. And Maureen I'll talk about why I like it, and perhaps Maureen will want to take the opposing view.
I look forward to it.
All right, that'd be fantastic, guys.
The gauntlet has been tossed.
We will wrap it up there. Thank you both so much for joining the podcast. It was a pleasure, talking about this with you.
Yes, thank you, Maureen. We appreciate having you.
Thank you, guys.
Please keep in mind that you should conduct your own independent research before acting on any of the opinions, information expressed during this podcast. And you should wait until you've discussed it with a qualified financial professional, or in this case, a tax professional as well, who's familiar with your personal situation and investment objectives before doing anything. And with that being said, thanks again. Have a great day. Remember to like and subscribe, and tune in next week for another podcast.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.